Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for September 22nd of 2024. Well, good to be with you. After a week's hiatus, we had some big news, actually, in the market. And the Federal Reserve reduced rates for the first time in a long time after a very long and protracted rate tightening cycle here. And so this last week, we got a half-point decrease or 50 basis points from 5.5% to 5%. And so, the market had fully expected this. This was priced into the market. Obviously, it was originally expected to start a lot sooner. Earlier this year, there was a lot of speculation on rate decreases, but it didn't materialize. And so we are now officially in a rate easing cycle. And so we're going to talk a lot about the implications of that. And we've got some historical data to show you with regard to, like, say, manufacturing and what happens to stocks and so on and so forth. But needless to say, we're in a rate decreasing environment now. And what we have over here is called the dot plot, and for obvious reasons here. But this is an assessment by the Federal Open Market Committee voting members on where they think rates are going to wind up. And so each dot represents like an individual FOMC member's assessment of where the rates are going to be, in this case at the end of 2024, at the end of 2025, so on and so forth. And so the blue line represents a median of those estimates tracking through the years. And so it just means that, that half of the observations are above this line and half the observations are below this line. And this purple line here represents where the market thinks it's going to be. And so, where we stand today, the market still believes that we're going to get more rate decreases by the end of the year. Right now, if it's 5 and it looks like 4.25, they're looking for another 0.75% decline. Whereas the FOMC members are under the impression that maybe we get another 50 basis points or 0.5% here. And then looking out to 2025, which is becoming much more relevant for forecasting purposes, that the market expects those rates to be actually below 3%, whereas the Fed voting members feel like they're going to be a little bit closer to 3.5%. You can see the trajectory on from there. But this is the start of a new rate regime, and just get ready for the implications. Here we have a couple of measures of investor sentiment. We have the name number on the left-hand side. We've got the AAII, the American Association of Individual Investors, the bull-bear spread. So these are both measures of relative bullishness of various groups of investors. And so on this side, we have the institutional investor, and you can see optimism has picked up a little bit. You can see here on the individual side that we have individual investors. Their enthusiasm remains relatively high too. So that is the backdrop under which we are working in right now. So investors seem to be relatively optimistic. You have speculative bets that are being made. There's a little bit more of a risk-on mentality out there in the markets right now, and obviously that could change. And I think that type of optimism does lend itself potentially to some volatility in the market, especially if you're in a year in which we're looking forward to a presidential election here in the coming couple of months, which I think in and of itself will be very, very tight, very close race, which a lot of people are speculating on what the policy implications are for fiscal policy here in the years ahead. We have a chart from B of A, global growth expectations. Oddly enough, we've got in that light blue, we've got the S&P 500, which we know has been moving higher, but at the same time, we've got global expectations still relatively muted. Again, this is a global survey, not the U.S. So interesting that we've got the S&P 500 here plotted and not the MSCI ex-US index, but nevertheless, you see that there is kind of a rough relationship here. The insinuation here is that that the net percentage of folks that are expecting the global economy to get better is a little bit down. Certainly better than it was maybe a year ago or so, but still the feeling is relatively muted for overall global growth. And amidst a time where the U.S. market is, pushing, higher. Here we have consensus expectations for earnings, expecting 18% in S&P 500 earnings growth by year in 2025. And you can see, how this has played out over several cycles here. You go back to the end of the last century, and we had the dot-com bubble, and then that burst, and then we had the global financial crisis. When you can see these patterns where earnings decline on a kind of a secular basis, and then here we have 2023 coming out of 2022, and that was a little bit muted. And, we've got an expectation here of some acceleration, and 18% would be, in my view, really not quite 3 times as high as what we might expect in a normal year, but it is close. Call it 2.5 times higher than what we would typically see in an average year for the S&P 500 earnings growth. So a lot of optimism built into the market. We'll just have to wait and see. Now, we talked about volatility before, and we've talked about it a lot over the last several months. And here is a measure of relative volatility when you are in a presidential election year. And as I've mentioned, heading into the election, you tend to have more volatility. I'd say here we are right now in September. Maybe you have a lull, maybe you don't, but that's fairly muted. But it does have a tendency of picking up a little bit as you head into election day. And then once there is that certainty, if you will, on who the successful candidate is, then that volatility tends to go down. Now, I think the risk in this cycle is that you have an election that's so close that it may very well not be decided on election day. It may take a couple of weeks of some relative uncertainty with ballot recounts, and we know, that there is a history of litigation in these matters, and so I think we just have to go into eyes wide open and expect maybe potentially some higher volatility overall. Now, when you talk about relative volatility, even 21%, that's more. You get 27, 28, that's reasonable volatility, and just by comparison, when we had the volatility spike last month, that number was actually closer to 50, 60. So that was a very strong bout of volatility. And what we're talking about here is not nearly that much, but it can pick up. And that's something that we should all be, ready to accept. On this slide, we have a picture of the S&P 500 in the black line. You can see that that number, obviously, the index has gone up. At the same time that we've seen Federal Reserve balances go down. And, this is the balances, reserve balances on deposit with the Federal Reserve banks. This data point was taken as of 9/18. And so typically when you see that come down, you see a response in the equity market. Now, I do know that we still have some narrow leadership in the market with some of the larger tech stocks. That has gone down quite a bit. We've seen much more breadth in the market lately, but as you can see here in prior instances, that you tend to see a reasonable correlation between these two. And so to have this gap, and we've talked about gaps, valuation gaps relative to conventional wisdom type items like this in the past, and this is something that doesn't necessarily make sense. Usually it gets rectified. We do know that the Federal Reserve is shrinking its balance sheet. And so this number is going to continue to eke down. And so it just gives us a little bit of pause right here on the continuation, near term at least, of the S&P 500. This is a chart from Nuveen Investments. Really interesting and illustrative, in my opinion. We've been talking a lot about, how to play the variability in the markets, how to play potential volatility. One thing that we've always looked at during these times, and it really served us well in 2022, was playing the theme of dividend growth and companies that have strong dividends, and those typically are, companies that have stronger financial strength that can obviously pay dividends, that have excess profits that they can redistribute back to shareholders. And this is a slide that tells us a little bit more about the power, the diversification power of those dividend growth stocks. And as we see here, the correlation is actually becoming more and more negative. This is the correlation of dividend growth and large cap growth versus the S&P 500. And so when you see this, especially with dividend yields that are, perhaps a lot higher maybe than they used to be, certainly higher than the S&P 500 index itself is. But the nice thing that you can see here, and of course this scale goes down and becomes increasingly negative. So when you think about negative correlation, that's really good when you're talking about risk. So if you have exposure to the S&P 500 and you're adding a lot of dividend growth to that, then that tends to have a negative correlation, which is excellent from a risk mitigation standpoint. Here we have basically a chart that kind of highlights the fuel to the fire, so to speak. And we've talked about this, just a couple slides ago, how the S&P continues to move higher at a time where Federal Reserve balances are actually going down. And this is one reason why that is the case. And we see foreign net savings. This is basically in this blue band here. You can see that the influence of that, starting right about 1980, when we had a lot more cross-border investments, and certainly as we got into the 2000s, that was a pretty heavy influence on the market. And even if you look kind of over the last decade, of course, we went through a period here in this country where net national savings had increased, and then we had the pandemic, and then we got more savings by virtue of stimulus payments, and then now that's gone negative. And we've certainly talked about net savings rates are moving lower, but at the same time, we have more foreign net savings that are here in the U.S. searching for a home, and that's doing a lot to help buoy our investment markets right now. Talk about the bond market. This is a very interesting development. So you can see very clearly that we had a negative sloping yield curve. So this is basically the 10-year Treasury less the 2-year Treasury yield here, and it was negative for a long time. And this is something that we, when this happened back here in 2022, we said, well, okay, well, this is clearly foreshadowing a recession. In fact, it did not, even though it got increasingly more negative as we went into 2023. And then that has actually reversed. And so we have a positively sloping yield curve now that is actually steepening. And so this is something that you would expect when you are heading into kind of a new rate cycle, which we are. We've got a new rate easing cycle that is now upon us officially as of last week. And this is a normal instance. Now, you typically want to see something about, maybe 100 basis points or 1% of difference between these two rates, and that would be symptomatic of a fairly healthy yield environment. But we're not quite there yet, but we are moving in the right direction. I have an excerpt from a Bloomberg chart, and this is another one of those anomalies that you just have to point out when you see it. And so essentially you have in the blue rate here, the blue line, this represents Fed funds. So these are short-term interest rates. As you know, we raised rates considerably over a multi-year period, and we stayed there for a while. We had our first rate cut last week, and so as I showed you several slides ago, we're at 5%. However, our 2-year Treasury yield, which we know has come down because in the last chart we saw that the yield curve is now positively sloped, And a lot of that is because of the dramatic decrease in the 2-year yield. So, but what's odd about this is you do see the tight correlation. Again, when you're talking about near term, like overnight rates, and then you're talking about 2-year rates, I mean, that's not a gigantic difference in time frame. It's not like comparing Fed funds to 10 years. But in this case, again, we've identified another one of these huge gaps, and the market is expecting rates to come down fairly dramatically over the coming months, and that's reflected in this 2-year curve. And the rhetorical question is, the bond market usually does a really good job of kind of identifying future trends out there. And in this case, what is the bond market telling us if the 2-year yield is moving significantly lower at a much faster clip than the Fed is in moving the Fed funds rate? And so, the rhetorical question is there something the bond market is interpreting that the Fed has yet to see, i.e., is the Fed behind the curve? Couple slides here on money market mutual funds, and a couple of interesting developments here. On the one hand, we do have this upward trend. This chart goes back to basically 1990, and you can see money market funds moving higher, and you can see various points in time where they have peaked, and you can see, and we've been talking about this too, that a lot of money has been moving out of conventional banks because they're not paying very much on outstanding checkable balances, and so they're moving into money market funds, and so that's obviously now moved higher. But B of A's research shows that the assets in money market funds typically peak about 9 months after the first rate cut, which in this case would put us roughly next summer at some point, that perhaps that those assets begin to go down. However, in a few slides later in their research, it shows that you tend to get more meaningful outflows only when the Fed funds rate goes below 2%. Now, obviously, we know that it is 5% right now, and so that may take a little while, and I think the circumstances under which we'd see a Fed funds rate of less than 2% would really be consistent with like a recession, which again don't see it right now. Not to say it can't happen, but it's not really in the tea leaves that we're reading at this moment. All right, so here is a chart from NDR, Ned Davis Research, and what it's telling us is that we have a lot of activity on the part of foreign central banks. And so, basically this is a reflection in the top half side that we've got the MSCI All Country World Stock Index, and you can see that over a very long period of time, going back to 1990, the general upward sloping nature of this chart. And what we have here is that we had, at this juncture, 2020, we had banks that were in net easing mode, and then everyone started raising their interest rates because inflation was running rampant. Then we peaked, and now you see that, in fact, a lot of other central banks around the world have already been cutting, and so we see this dramatic easing on the part of global central banks well in advance of our own central bank. And so, it's an interesting backdrop to see a lot of easing that's happening at the same time that there's a lot of kind of muted sentiment with regard to towards global economic growth that we saw really in the first couple of slides that we showed you here today. Another interesting chart related to the market is this one. We've had a lot of corporate buybacks. What does that tell you when you get a lot of buybacks? And what it tells you is that companies have a lot of surplus free cash, is what we call it, and they're looking to return that free cash to shareholders. And so you can do that through dividends, and obviously we've seen a lot of dividend raises by publicly traded companies, but they also go back and repurchase their own stock, and that is viewed, from from a technical, well, more from a fundamental standpoint as a bullish signal. If you're going and buying your own stock, obviously we're all investors, whether it's individuals or companies that are trading in their own stock, and they typically wouldn't go buy their stock back. The theory goes if they didn't feel like it was a good investment. But we have seen a tremendous amount of buybacks, and this has had some influence on the market. It has actually had some influence on that expectation for earnings growth, because when you start buying back your own stock, that takes more stock out of circulation. Now it's still outstanding stock, but it's now pulled into Treasury, and the more that you do that, the more that you can help to inflate your earnings per share. Here we have a chart related to small caps, and a lot of speculation on what the future holds for small caps. And I'd say in some respects, when you get into a rate cut, a new rate, an easing cycle, as they call it, that would tend to be good for small caps that are much more interest rate sensitive on the debt that they're taking on, and because they don't have the financial wherewithal of larger companies. And basically what this says, just in terms of stock performance, is that you tend to have better overall performance after, relative to large caps in the 6 months after the first rate cut. And even though they may not react immediately, you tend to get a little bit more juice when you get out 6 to 12 months. And so, there is a value bet to be made right here, because small caps are, just let's cut to the chase, they're a lot cheaper than large caps are at this juncture, and they're priced a lot closer to their current, their long-term average, whereas large caps are priced well above their long-term average. And so, again, this is something that kind of speaks to portfolio diversification. The small caps, have value, and the question is, when do they kind of get that catalyst? And now that we're in a rate decreasing environment, that would tend to bode well as you look out probably into the spring, closer to the summer months next year. Here we have gold. Gold is at all new highs. You can see the trajectory here. This is a chart that just goes back to the beginning of the year. Gold, basically all new highs. I mean, it really has been a great investment here. And the fact that gold typically does perform well when you get your first rate cut. And so, when you look out over, these are historical backdrops when we have, when we've had rate cuts. And here's the average price action if you look at it both on 250 days, or about 3/4 of a year, and you look at it on a 500-day basis, that you tend to get really good response from gold, even at a time where we're touching all new highs. Here we have a chart from Fidelity mapping the US dollar against 2-year Treasury yields. You can see the dollar in the black line here. And we really have traded in a band for a little bit now. This is going back to essentially the beginning of 2023. And we've been in this channel at the same time that we've had kind of a jockeying of sorts in 2-year yields. And, we've seen peak of 5% a couple times. We've seen it go as low as 3.8 right now, as we just showed you a few slides ago. 2-year yields now moving around 3.6, which has resulted in that positively sloping yield curve, because 10-year yields are higher than that. But at the same time, when your yields are falling, that becomes, the simplest way to explain it is, it's a relative value proposition. So when your yields are high, there's a demand for your currency, because, there's a demand for those higher yields relative to yields that could be obtained in home countries. And so that tends to inflate your dollar. But when your yields go down, then that relative value proposition goes away, and the dollar tends to fall in response. And you can see the interesting relationship here. But suffice it to say, if this is the band that we're going to be working in, that the dollar currently is at the low end of that. Well, just as we've been talking about in the earlier slide about growth expectations for the rest of the world being somewhat muted, it's very clear by this chart that the viewpoint in the U.S. is much more optimistic. In fact, looking back to the summer of 2023, when we weren't really looking for much of any growth at all, and I think the sentiment was that we are going to have a meaningful slowdown, and we kept looking for that. But the estimates for 2024 have really moved a lot higher. And so again, when we were sitting at the summer of last year, the expectations for 2024 GDP growth were really low. Now we're looking at 2.5% on an annual basis, which is the highest point that we've seen so far in this survey. We've got daily crude oil production. I thought that this was really incremental. This is actually from Arbor Research, but it was reported in some research by Liz Ann Saunders at Schwab. You can see the irony here is that you got Saudi Arabian production that's moving down to about 9 million barrels a day. At the same time, that very silently, we haven't gotten a lot of press on this, but U.S. production is basically near an all-time high of 13.2 million barrels a day, which means that we have become much, much more self-sufficient in terms of our oil needs. But at the same time, despite the fact that Saudi Arabia is running lower production, I should say, that the weight of the U.S. increase in production is helping to keep overall prices on the spot market lower. So now looking at the index of leading economic indicators, you can see in this chart that goes back to 1960 here, this represents, and we've shown you this before, like the number of consecutive months of trending LEI. So this would be like, consecutive monthly declines in the LEI. And you can see that we just ended a period of 23 straight months where the LEI leading economic indicators were in decline. And then that shifted earlier this year, but now we've had 6 straight months of LEI declines. And you can see the components of that over here, that we basically have manufacturing new orders, which have been weak. We've had some degradation in consumer expectations, and then we know that interest rate spreads have become really, really tight. But on the flip side, we have seen credit conditions be better than expected, building permits, and jobless claims are all relatively additive to this environment. So it is a little bit of a mixed bag, and but if you are of the opinion that the rate easing cycle that we just entered, that we've been talking about so far, if that takes hold and it leads to some economic growth, because it would stimulate borrowing, it would stimulate small companies, et cetera, then you'd expect this to want to turn around and go back down, and that we would have stronger overall LEI numbers in the months ahead. Here we have wage growth. We've been talking about wages and rents as the prime sticking points for inflation. And what we see here is that it looks like wage declines have kind of ebbed, at least for the time being. Again, this is not something that terribly concerns me, but you can see pre-pandemic, they were looking at 3.2% annual wage growth, and basically we're at the same point right now. But the fact is that it's not continuing to go down, at least right now. And you can see that basically on these different wage cohorts, whether it's low, middle, or high wages, they've all kind of crested down here. And the question is, are they going to move back higher? We do have, hiring intentions that are going lower. We have layoff announcements that are, relatively muted. It just means that people feel like maybe we're kind of close to full employment. We have seen, some layoff numbers, but when you see layoff numbers move higher, you typically wouldn't see wages going up. So this might be kind of a false positive here. It might just be that this is kind of where we're going to be going forward for at least the near term. So the other side of the coin is rents on the stickiness of inflation. So we just got through talking about wages, maybe kind of cresting out for the time being. Here we have something that would tend to indicate that rents are going to continue to come down. So what this is U.S. multifamily completions. And just think of this as apartments. So, the apartment completions here have really rocketed higher. In fact, they're the highest since 1974, which is pretty outstanding. And you can see that this number has gone up considerably in a relatively short period of time. So when we think about new apartments coming along, the fact that we have a rapid increase in those number of apartments coming online, that should help to bring rents down because of the increased supply. And again, I would offer that this is on a national level. It's not on a regional basis. So, there could be different dynamics in different markets, but overall, more evidence that we should see decreases in rents going forward. Something else I thought was interesting in the real estate industry is that we have an increasing number of homeowners that do not have a mortgage. We're basically up to around 40% of all homeowners do not have a mortgage. We've talked a lot about, obviously higher mortgage rates, even though mortgage rates have come down even more. But, in affordability being low, but, a lot of people have been able, for one reason or another, to eliminate the mortgage on the books. And so this kind of really speaks to some degree to the health of the overall home owning consumer out there. And you can see that this is something that has been, moving forward as we've gone from 33 to roughly 40% in, call it about 12 years, which is pretty amazing. I'm not sure, what kind of hard inferences I can draw from this from an economic standpoint. It just tells me that you have a healthier overall homeowner, even though it might be still fairly difficult for new homeowners to buy a home or people on thin budgets, but that we've had a dramatic rise of home ownership that's not associated with mortgages, meaning that the impact of higher rates may be less profound than maybe we would have guessed. Here we have some Philly Fed data. We've got the manufacturing index, which oddly enough picked up. It went positive in the last reading. In fact, the consensus estimate was looking for flat, and we actually got positive 1.7. So, again, that's 1 month, and you can see that this data has been a little choppy over the last year or so. But the fact that we see that positive is good. Capital spending, which is really important to economic growth too. We saw that one rocket up. And again, this is the Philadelphia Federal Reserve region. And so, as you know, we look at a lot of different data from a lot of the various Fed regions, and this is just one. But it is encouraging, at least, in the last data point. Here we have the first rate cut analysis as it relates to manufacturing. And as you just saw, we had a little bit of positive, at least near-term development in the manufacturing side. And what this tells us too, again, this is from B of A, that once you start easing again, and we just started easing last week, that you tend to see a better performance out of manufacturing. So, this would be kind of like the current cycle that we're heading into, and obviously manufacturing, as we know, has been in a bit of a recession, but we see green shoots that potentially could turn that positive. But as you see, the average manufacturing purchasing managers index, when you're not in a recession, should go up over time. And so, again, that kind of speaks to the fact that if you lower rates and you're not going into recession, then it would be viewed as stimulatory to the economic growth, to the capital spending plans, which we just saw in that last chart, which is moving higher, so on and so forth. Here we have those mortgage rates moving down 6.1%. Here we have existing home sale inventories. This is the month supply. And look where we troughed a few years ago, down around 2 months supply. We're now at 4.2. If you go back to prior pandemic, you were, somewhere between 4 and 6 months. And so we're getting back a little bit to where we need to be from a health standpoint. And existing home sales are much, much more important to housing than new home sales are in terms of aggregate numbers. And to see months of inventory kind of tells me that the market is getting a lot more healthy. That's all we have for the chart pack this week. Hope you've enjoyed it. Have a great week, and we'll talk to you again soon.